Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah. Well, you guys might accuse us of talking to every IT company that is out there on the street, but just the performance given by most of them compels us to do that, and Happiest Minds is no different. The gentlemen who join me every time to talk about the quarter and the outlook ahead, Venkatraman, Narayanan, and Joseph Anantharaju join us right now to talk about the quarter gone by and the outlook ahead. Venkat, great having you. Joseph, great having you as well. Thanks so much for joining in. Venkat, and off the blocks with a bang, so to say, over 9% is pretty commendable. Is this a sign of things to come, or is it difficult to say that? And of course, please tell us what went behind this 9.6% quarter-on-quarter growth.
Good morning, Neeraj, and thanks for giving us this opportunity to talk to you and your people about our results. Yes, we have started the year on a very strong footing. 9.6% revenue growth in dollar is a number most of us aspire for. And largely this is organic if you look at it, because we had subsumed the acquisition of PGS in Q4 of last year. So our QOQ number is largely organic, or 100% organic to that extent. What our expectations are, we have said that we have set that straight with the market. We are looking at about 20% organic growth in the medium to long term on an organic basis. So that's a real stretch target. If you look at only FY22 rather, we would beat that number, but the challenge or the task ahead of us is to keep going at the similar pace for the next few years to make sure that we meet that number of 20% organic growth on a CAGR basis.
Well, 20% seems a bit more modest compared to what you've done in quarter one, considering that except for that $0.9 million contribution, almost everything is organic. So is there uncertainty in the environment, or are you just being conservative for FY22?
As for the environment, I would request Joseph to talk about it, but we have been expecting this demand pull to come in. We have been kind of warning ourselves that we need to prepare for it. From Q4 of last year, we had put our hiring engine back in place, because if you really look at it, the two parts of the story is demand and supply. Demand was there, and we were getting to see those green shoots, or whatever you say, from Q3 and Q4 of last year. We started preparing for it. And I would like to say that on the delivery front, by adding 310 Happiest Minds in a quarter, on a net basis, was really our way to meet that demand. So I wouldn't say it's a surprise. We are planning and we are hoping to see a similar demand uptick, or maintaining the same numbers, similar numbers going forward for at least the next 3 to 4 quarters. Yes, 20% looks modest when you look at only the results or the possible results for FY22. But what we are saying is it's more like the medium to the longer term that we are looking to maintain a CAGR of 20% on an organic basis, Neeraj.
Yeah, but just before I get to Joseph, so therefore you are saying that 20% is definitely achievable. The growth may actually surpass that as well, because frankly, I mean, Venkat, the ask rate for a 20% for FY22 is really very, very modest. If you do that, maybe people, or you yourself, might be disappointed.
Yeah, FY22, absolutely. You're right on spot. And we are not letting go of any demand for sure. And that 20% is not a bar that we set for ourselves. We will go much higher than that if you really aspire for it in FY22. But for the longer term, we have to see how this industry stabilizes. There are peaks and troughs, and there are points of stabilization as well. So we have taken into account all of that, and that's how the long-term number of 20% has been put forward, Neeraj.
Yeah, no, fair point. And fortunately or unfortunately, on the periods of the troughs, people will forget that you have all across told them that expect 20% CAGR. People will say, "Arey, itna kyun nahi hai?" Any which ways.
Absolutely.
Joseph, talking about the demand environment, because it looks solid for most companies which are not even a patch on the digital side as you are. How is it looking?
Yeah. So, we talked about Q1 performance, and I want to give a little bit of color, which also portends for Q2 and maybe rest of the year, Neeraj. If you look at our Q1 performance, I think what was happening is cutting across various verticals and geos, we saw growth in absolute terms. You may see some upticks and downticks in percentage of revenue because the overall revenue grew a fair bit. And if you had a smallish growth, your percentage or proportionate share, whether it's a vertical or geo, would have come down. So that was a positive sign, seeing a secular growth across verticals and across geos. And in terms of the demand environment, we continue to see a lot of investment going in, again, cutting across verticals. Though you could say that some verticals are maybe they planned for it a little earlier, and therefore they've been faster off the blocks in terms of starting initiatives and accelerating the spend. But what we've been seeing is that all of the verticals are seeing increased spend, and it's basically driven by the realization that that consumers expect their experience and their products in a very different manner thanks to pandemic, and it's accelerated the whole digitization effort. And companies have realized that what they plan to do in 4 years needs to be done earlier, and those that hadn't started, to survive, they have to get going with their digital initiatives. And that's the demand that Venkat was talking about. So we're seeing demand that can be sustained surely for FY22, hopefully beyond that as well.
What about, Joseph, what about verticals? Because again, out there, while, for example, the standard verticals of BFS have looked mixed bag for, or patchy for some and very strong for some, I'm still getting mixed cues, particularly about BFS, particularly about NA. And then, of course, those might be the standardized verticals. Depending on how you categorize some of these. How is it shaping up for you within geographies and within areas, particularly, of course, with specific color needed on BFS?
Okay, so I'll take BFS last. I'll spend maybe a minute on that. But in terms of Q1, the verticals where we saw increased revenue and traction were edutech, media entertainment, high tech, and retail. And there were some specific factors driving that drove the growth in these segments. If you look at retail, last year the overall grocery industry grew by 12% as opposed to typical 1 to 2%, and most of it moved online. So a lot of expenditure and investments on how to use data, AI, process automation that's happening in the retail industry. EduTech across the board, most of the education providers were not really ready for this level of remote learning and digital learning. And so they're trying to bridge the gap between online and in class, because you need to have a hybrid environment. You need to make sure that the kind of in-class experience that you had, you need to provide it in a virtual manner. And also the gaps, especially in K-12, the gaps that you have for remediation, it's very different if you're in person and if you're online. So your learning platforms, etc., have to be different. So it's quite a bit of investment happening to bridge these gaps. Digital media, as streaming platforms, they've really taken off, and all the major studios, broadcasting companies are investing heavily. And some of our offerings map on very well around data analytics, AI, etc., cloud to the space. High tech underpins all of these digital transformations, so that is doing well. Now coming to BFSI, we've been focused more on the mid-market segment, taking some of the SaaS platforms and helping the community and the smaller banks. And so our experience may not be as reflective of the overall industry. We've been flattish for Q1 in the BFSI segment. And here again, we have a large customer in Europe where we finished the first phase of the transformation. And so there's a little bit of a gap which led to flattish revenues. But this is an area which we've taken up as a focus in terms of building more depth from a vertical perspective and build more heft and increase the revenue. So BFSI is an area that we will be focusing on going forward with specific focus on fintech, because that's where we'll be able to differentiate. Even the community banks, the mid-tier banks that I mentioned, we're going more with with the latest platforms with companies that have been founded in the last few years, helping them with their digital banking, and that's a strategy that we want to take to the larger banks as well.
Okay, very interesting, and all the best for that as well. Now, Venkat, if I can come back to you and talk about the hiring piece, because you obviously have hired, the headcount has indeed moved up. You mentioned the number as well, of course, but when I just look at that 9.6% QOQ headcount, it does show that you're prepping up well for delivery ahead. I hear from everybody that because it's a red hot market, the cost factors for the headcounts might be a small drag on numbers. Now, when I look at your numbers, Q1, I don't think you've given any kind of a wage increase, right? So is that coming up in Q2 or Q3? And could it have a bearing on operational metrics?
No, we had given a pay increase effective Q1 and did disclose this in the last quarter financials as well, because we gave it effect from January 1st. We had started taking the P&L impact from last quarter, but the real cash payout started happening from this quarter. So yes, we have given a double-digit pay hike on an average to our Happiest Minds. So that's done, and that's factored into those financials. There are two elements. One is you typically need to understand how the levers that we have in the IT industry, I'm sure the oft talked about, utilization, the span of control of the pyramid, the on-site offshore, and the pricing power that we as a service provider have. If you look at it, on utilization front, pretty much optimized at about 82%. We have been always saying, guiding that we would like to be in the 78-80 range, but we are at 82%. And that's maintained. As far as the span of control, that's slowly improving, because as the size of the company improves or grows, you have efficiencies coming in. So that's a second part that we're working on. The third is the on-site offshore split. We are currently 95-5 in terms of people numbers between on-site or outside of India and inside and India are concerned. Slowly that's changing basis what customers really want. And the pricing power. So you must have talked, we have talked about this in the past. During the start of the pandemic, we did make some adjustments temporary that maybe to adjust for the customer requests on pricing and the difficult period that all of us were going through. But happy to say that that's slowly starting to reverse. In fact, the pricing power is coming back into the markets, for digital work. So these are the various levers that we have to make sure that we are able to address the cost increase that's happening in the system. Yes, there would be temporary blips, because when attrition does happen, it happens at a particular range. It's between 2 years to 6 years kind of an experience. That's a bracket in which we see increased attrition, and that has a distinct impact on your immediate margins. But you have to cover that up with volume growth, price increases, and all the other efficiencies that I talked about. Yes, there could be challenges. And if you look at it, we did have a drop in our gross margin by about 170 basis points. We did cover this in our financial and the analyst call. And it is partly due to the increased price pressure that we're talking about. Despite that, we have managed to maintain our EBITDA at the 26%. And we are hoping to build on the efficiencies that we have put in place and take on this whole cost pressure head on. But let's see how that plays out in the next 2 to 3 quarters. But yes, the short answer is there is cost increase pressure, and we have to take that head on and handle that through the various metrics and the levers that I talked about.
Okay, I did see that pressure, but I thought that was largely on account of maybe increase in travel expenses and subcontractor costs. So excuse me, I thought maybe the wage hikes are due to happen or due to be accounted for in some quarter in FY22, and which is why I was asking that question.
Sure.
Fair point. Joseph, one final question to you, and then we wrap up with one final question from Venkat as well. What about we spoke about this aspect in the last call, Joseph. Maybe you remember, maybe you don't, but the aspect of client mining. And as I see that larger or the bigger client number for you keeps on increasing every quarter, and every note that I read speak about the possibilities of this increasing client mining. Now my question to you is, are you already showing some signs of that which people are maybe not reading, or maybe I'm not reading, or will you actually show telltale signs of that in the quarters to come?
So it's a good question, Neeraj. If you, as a base, I think your observation is right. If you see during the quarter, we've added $7 billion customers. That's moved up from 46 to 53. At the same time, if you look at our $1 million customers, that's also moved up by 7 during the quarter. So we made 6, sorry, during the quarter. So there's been a fair bit of concerted effort, which has resulted in tangible outcome from point of view of size of customers. And overall, if you again see average revenue per customer, that's also ticked up a fair bit over the last 3-4 quarters, and it has shown a consistent increase quarter on quarter. And this is an area that we will continue to focus on. We've seen the median revenue per customer move up. We've also seen number of customers. If you break down the $1 million and the 1 to 3 and 3 to 5 further, we've seen movement upwards in terms of number of customers if you further subsegment it. And so there are tangible outcomes, as well as there is movement that we are internally tracking.
Just to add a few numbers to what Joseph mentioned, Neeraj, 90% our repeat business continues to be at 90%. The average size or revenue per customer has moved from 630,000 to 750,000 year over year. That's a significant jump. Our share of business from global billion-dollar corporations has ramped up nicely and significantly. Now we count 53 customers, billion-dollar corporations in our customer base, like Joseph mentioned. And so we also track the contribution from those customers to our overall top line. That's something that's increasing. So all the metrics that Joseph mentioned really supports the customer mining that we have been talking about all this while.
Okay. Well, maybe that and then a few other pointers help you sustain this tremendous growth that you're showing. Gentlemen, both of you, thank you so much for speaking to us today and giving us some sense of how quarter one went by. Look forward to talk to you in the next quarter.
Thanks, Neeraj. Happy to be here.
Thanks, Neeraj, and keeping our fingers crossed.
Yes, the pleasure of having you is ours. Thanks for tuning in. Thanks for joining in, rather, and viewers, thanks for tuning into this conversation.